All right. Here's what we're going to do, and I appreciate everybody for being here today. And it seems like the most difficulty we're having with the iPads is figuring out how to prop them up, BJ. But we have around 5 speakers, and what we're going to talk about mainly today is just talk about policy, about what kind of revenues we get as a state, what the proper mix of revenues, what people look at when they look at the stability of a state's financial position, because we do not want to mess around with the tax code and, on the premise of trying to fix things, put us in a position where we have unstable sources of revenue or unreliable sources of revenue. So we want to be very, very careful about what we do. So it's important that we talk about policy before we ever even talk about the specifics of a bill. Representative Carson has presented a bill that is very detailed, and he has been working on this for at least 2 years and has been doing a phenomenal amount of research and has gotten down into the weeds. And regardless of whatever happens with this bill, the information that has come out of this process has been, I think, invaluable for us in future planning, regardless of what happens this year or next year. So at this point in time, I'm going to ask Mr. Carson to make a brief presentation. He's got a PowerPoint that you see. We're not going to go through this line by line by any stretch of the imagination, but it is a resource for you to use in this committee or outside of this committee, because it is very, very detailed. And it's based on a lot of data that is well researched. So Representative Carson.
Thank you, Mr. Chairman. First of all, I want to appreciate everybody being here. This is obviously a big issue. It's an issue that we launched publicly with a press conference back in February. We had a committee meeting in March, and I appreciate those of you who were here back during session for a hearing. And I really appreciate your willingness to come out and to listen to this on a weekday in the off season. So that I know I speak for the chairman as well. That is very much appreciated, your work toward this. Just as the chairman mentioned, we've been working on this for at least 2 years, and I really don't want to start without thanking a couple people, and that's Jeremy Betts, the committee analyst for Ways and Means, as well as Laura Hurd. They've been invaluable as far as resources and so forth. Also, as the chairman mentioned, we don't have, as of yet, a detailed bill. We have obviously a bill that's been introduced, and it's out there on the website, and there was a committee sub done to that. Some of you may have seen a press release that we have some changes already made to the bill. As an administrative point, Legislative Council is not able to update the bill with all the specifics because the software has not yet been updated. I don't know if we have a representative from Leg Council here yet, but we don't have an LC number as of yet, except for what's out there on the website with a few modifications. To the chairman's point, what we're going to be talking about today is overall data, analytics, and policy more than anything. Jeremy, I think everybody's got a copy of this, and I've got a printed copy. Most people should have this electronically. Just a very short 61-page presentation that I will not be presenting 61 pages. The second page is an overview of the major tax changes that I would propose based on the research that I've done, the analysis, and so forth. This should look fairly familiar from what we discussed back during the hearing. The individual income tax rate, and all these changes, by the way, go into effect over a 3-year period. The individual income tax rate would go from 6 to 4%. The corporate income tax rate would now go from 6 to 5%. We would phase out a number of income tax credits, but we would keep many of the ones that are directly related toward jobs. And I'll get into that in a minute. But this bill is all about lowering the income tax, individual and corporate, and providing a growth environment for jobs. Keeping many credits, just the ones that are mentioned there are just a few: film industry, video programming, jobs, R&D, investment, manufacturing, low-income housing, and so forth. The sales tax rate would need to go up by 1%, and I will get into that in a moment. and you'll see the changes on the sales tax base. Next page, page 3. I'm on this slide right here. Why are we doing this? I have 4 pages about this, but the first one I wanted to highlight is jobs. Georgia has the second highest top marginal tax rates in the Southeast for individual and income tax. We have maps later in the presentation about that. In addition, our economic growth potential is quite limited. You can see a quote right there from the Tax Foundation from one of their research reports. And you can actually, for those of you in the committee, you actually click on the link over there in the reference column. It'll take you to a different slide. You can click on the link at the bottom for Tax Foundation Special Report, and it'll pull up a web page. I presume everybody has web access. So it'll pull up that report from the Tax Foundation. Next slide, I think this is page 4 in the PowerPoint. Georgia's AAA bond rating. We've talked about that quite a bit. Nothing I am doing has any intention whatsoever of jeopardizing that. I would argue, conversely, it would strengthen it. Georgia is one of 15 states that has a AAA rating, and we'll go into that in a minute. But I would argue that we are a little bit over-reliant on income tax revenues as compared to our peers in that category. In addition, S&P in its January 9th credit report, from their research report up here, if you can take a look, S&P issued a report June 9th of this year, and on pages 4 and 5, they issued a concern in regard to the constitutional amendment that we passed as a General Assembly, the voters passed as well, to basically cap our income tax rate at 6%. S&P maintained our AAA rating, but nevertheless they wanted to make sure that we have various levers that we could pull if income tax is not one of them in order to raise revenues in the midst of a concern. Just going quickly through, also on page 5, moving on to page 5, one of the reasons I would prefer to go to more of a consumption tax, not just because of a revenue mix issue, but secondly because of a seasonality and volatility issue. We can take a look at that in a minute. You can see later charts where the income tax revenues are much more cyclical and seasonal, and sales and use tax, i.e. consumption taxes, are more consistent. On page 6 of the presentation, my reform bill also addresses several loopholes in the consumption tax base. Now, politically speaking, an income tax cut is easy. The policy is the difficult part in regard to how do you pay for it. The growing sectors of our economy are more digitally delivered items. By the way, I'm on page 6 of the PowerPoint. So text messaging, streaming of music, streaming of video, direct broadcast, satellite, and so forth. Georgia's Title 48, the revenue code that we all work and live in, only taxes TPP, tangible personal property, but not intangible items. And as a result, even for consumer purchases, our tax base continues to shrink and erode. And also, we are talking about the state exemption on groceries. The Tax Foundation has some findings in regard to that. We also have some analysis in regard to what would the difference between the sales and use tax revenues going up and down year to year versus state consumer spending according to the Bureau of Economic Analysis. And I know this is a very much of a lightning issue. I will say on one end, on a policy standpoint, we are precluded from taxing groceries for food stamp purchases. What I would propose is that many of our senior citizens, since they've been paying income tax for 40 years, we provide an exemption for individuals 65 and over for groceries. What we're talking about is lowering the income tax and going to a consumption tax in a fair manner. With that, I'll go to page 7, and I'm just going to highlight some of these items, Mr. Chairman, probably about 8 or slides or so. Page 7, this is a map of state individual income taxes. You can see we're the second highest in the Southeast, second only to South Carolina. Page 8, we're the second highest in corporate income tax rates, second only to Tennessee and Alabama. There. Page 9, you'll see this is, again, a refresher from what we had what we presented in March. The Atlanta Business Chronicle noted a study where we are the 9th worst state for income tax. In addition, that was based on a ranking from Go Banking Rates. If you take a look at right here, this Tax Foundation report, the 2015 State Business Tax Climate, just on page 2, I'm happy to send this around. Our individual income tax rate is 42nd out of 50, not including D.C. Next slide that I'm working on. We've talked a lot about the AAA bond rating. We don't want to jeopardize that. I will say, and many of you know that I work in finance. I can tell you that this is a huge issue, because if we were to lose our AAA rating and our interest rates went up, say 25 or 50 basis points, or half a percent, our interest rate expense would definitely go up, like I said, by half a percentage point, and that would cost us millions and millions of dollars against 9.4, 9.5 billion with a B of general obligation bonds. If you take a look at that slide 10, Georgia, if you can see there in the blue, Georgia is highly reliant on income tax revenues. And this data is from the 2014 Survey of State Government Revenue. So what we did is we looked at state governments, where their revenue mix is. I believe this is for calendar year 2014. I could be incorrect. It could be fiscal year, but I believe it's calendar year. And if you take a look, you see Virginia all the way to Wyoming. These are 15 states that are have a AAA rating according to S&P. What we're saying here is we obviously want to maintain our AAA rating, but even if we were to lower our income tax and be more reliant, not completely, I want to stress that, not completely reliant on a consumption tax, but more reliant on a consumption tax than we are now. Let's say if we went to, say, 40% revenue mix on income taxes, and maybe slightly less, maybe going from 5.5 to 5 on corporate income taxes, we would still be, how should I say, in the middle of the field, if you look at this graph, between other states that have a AAA rating, between, say, Maryland and Iowa right there. So I don't think, the point is we're not doing anything that's completely out of the realm. If you look at this chart, I would urge you to take caution when you're comparing us to North Dakota, Alaska, or Wyoming. Everybody see the light green in the chart? That is severance taxes, so oil and gas. We don't have royalties of oil and gas off of St. Simons that I know of. Next slide, it just compares our revenue mix to other states, again, that have the AAA designation. And page 12, this is some analysis that we built. This looks at the seasonality of revenues. And Mr. Chairman, if I may, I'd like to thank the Department of Revenue as well, because they've been absolutely instrumental in providing data and guidance on that data and so forth. So I really want to give them a big thanks as well. This is historical data on a monthly basis for state revenues from January 2003 to December 2014, stacked by month, to assess seasonality. And what you can see there, I hope everybody's looking at it, what you can see there is that there's definitely a dip in February as well as March, and that you would believe that to be the case because most people that if they're filing an income tax return, if they're going to file it that early, more than likely have a refund. Your higher receipts come in a little bit in April and the first few weeks in May. Slide 13, this is the seasonality, same concept, but seasonality of the corporate income tax. Excuse me. And you can see that it's heavily weighted toward the quarter ends when people are making their estimated payments. I see Representative Peake shaking his head. However, you take a look at slide 14. This is the state sales and use tax seasonality obviously for consumption tax. And you take a look, it has some variation, but not near the amount of variation, and not near as much variation per month or between years, because you're dealing with consumer spending, which is more consistent than income tax reporting. Slide 15. This is, and I know I'm moving quickly. I'm on this slide right here. I'm going to have to move quicker. Okay. This is a comparison of the volatility of income tax and corporate income tax versus sales tax. And my point here is that the income tax is terribly volatile, seasonal, but the sales and use tax, the consumption tax revenues are not. Page 18, we've seen this before. This is communication services tax reform. I have a slide in here, page 20. This compares Georgia to other states. We don't have a tax on DBS, digital broadcast satellite, but many of the states in the Southeast do. And as a matter of fact, the average sales tax rate that of the other 8 southeastern states that tax digital satellite services is a little over 7%. Page 21 is a little bit new. There was some discussion that we're trying to pay for, and I'm on page 21, this page right here. There was some discussion during session that we were trying to pay for an income tax cut with a satellite tax. And what I'm doing here with the pie charts is to show you that is clearly not the case, because what this communication services tax would do would be eliminate all exemptions for consumer purchases of communication services. And if we raise $100 million or so with satellite tax revenue, that's really going to lower the sales income tax from 6 to 5.95%. I don't call that paying for an income tax cut. Mr. Chairman, there are some other slides here. I don't want to rehash what we've talked about before and prior hearings. I'm sure your board is lit up with questions, or will be. So I leave it to your discretion. Would you want me to share a couple of more, or would you like me to answer some questions at this time?
No, I think we need to answer some questions if there are any, but keep in mind, and I appreciate you not getting into the weeds about it, but basically dealing with the information as far as revenue sources. And I think that is probably where we want to focus on today's date. If the members of the committee, and I know that you haven't had a whole lot of chance to explore through your iPad, but there's information from the Department of Revenue as far as the mix of income and revenues for the state of Georgia for the last 4 or 5 years, so that you can see how income tax, sales tax, and other revenue sources, excise taxes, play into that mix. And you also have some charts that I think that show what some other states that have AAA bond ratings, what they look like, what their mix is like. I would ask Representative Carson if you know the answer, because even though we've got 15 states that have AAA, and some of those states have different kinds of revenue mixes than the state of Georgia, what we are interested in is the stability of Georgia's system versus other states. Do you have information about how long those states have maintained that AAA bond rating as compared to how long Georgia has? Because if somebody just got on the list this year, then that would indicate perhaps to me that their revenue sources are not as stable as Georgia's, and so they may have moved on the list this year. They may move off the list next year. And so I think it's not only the list of AAAs, but what kind of longevity that they have during the Great Recession or during other kinds of volatility type issues. And I think that's important that we look at that as well. Do you have any information on that?
I do have that. Thank you for that question. I do have that information, Mr. Chairman. I don't have it with me. We can easily circulate that out to the members of the committee and whoever you think would be interested in that. And I would also, if I may, add that in addition to the 15 states that are rated AAA by S&P, there is a subset of those states that are AAA rated by all three rating agencies, including Moody's, including Fitch. We can provide that as well. Clearly, not all 15 have had these ratings as long as Georgia has. I believe Alaska recently entered that fray not too long ago. So, but yeah, we can absolutely provide that. If I may, I want to add one other thing in regard to, I believe we have a speaker in regard to AAA ratings and criteria and so forth. I wanted to read, if I may, page 2, not the entire page, but just the 4 bullets in regard to, again, this is a Standard & Poor's research report from January 9th of this year, where they reaffirmed our AAA rating. And under the rationale section, page 2, the AAA rating reflects our assessment of Georgia's well-diversified economy. Second, strong financial monitoring and oversight with a history of budget adjustments to restore fiscal balance. Third, i.e. quality of the revenue shortfall reserve, or better known as the rainy day fund, which, as you know, under this governor is increasing with its in its stability and obviously its growth, approaching $1 billion. So 1, well-diversified economy. 2, strong financial monitoring with a history of budget adjustments to restore fiscal balance. In other words, about our balanced budget every year. 3, quality of our revenue shortfall reserve, or rainy day fund. 4th, moderate debt levels compared with rapid amortization of our debt. In other words, I would split that into 2 issues, sub-issues. 1 is the level and amortization of our general obligation bonds, and 2nd is the overall health of our pensions. Those are criteria that S&P cited as far as why they're rating Georgia a strong, financially stable state.
Representative Peake.
Thank you, Mr. Chairman. Thank you, Representative Carson. That's good stuff. Just an observation and a quick question. It is interesting that we've had this debate that the concern has been the AAA bond rating and the potential inconsistency of sales tax revenue and a dip in the economy and dip in revenues. But it's interesting from your graphs that actually the more consistent, stable source of revenue is that sales tax rather than the income tax. It's kind of you think maybe it'd be the other way around, but I think you've done a good job of proving that there can be consistency on a consumption tax on a going-forward basis, which is crucial. And I may ask kind of the same question, piggyback off of where you were going. Have there been any states, not that have moved from AAA to on this list of AAA rating, but any states that have reduced their state income tax in the last decade and seen any repercussions of a lowered bond rating or decrease in revenue or inconsistency in revenue? Any states that we could look at that have done what we have tried to do or trying to do, or what you're trying to do and proposing in your bill? Got any history there that we could maybe piggyback off of?
Page 46 of my presentation.
Okay.
I met with Representative Peake. I met with the governor in his office, I don't know, second week of July, and he brought up this concern. And one of the main concerns brought up was Kansas. And I believe we have a representative from the Tax Foundation who's going to speak to the sort of the hiccups that they had in Kansas. One of the things they did is that they did not have as well diversified as economy, I don't believe. Second, and this is the bigger issue, and I appreciate you bringing this up. What they did is they cut the income tax rate too much and didn't budget their expenditures as appropriately. In other words, they cut their income tax rate. Their fiscal note said that it was going to go down by X amount or Y amount on their phase-in period, but they didn't reduce their budget expenditures, or they overestimated. A better way of saying it is they overestimated their revenue coming in as a result of those tax cuts. One thing we're doing here is we're not talking about a multi-billion-dollar tax cut. What we're talking about is a very minimal tax cut, but moving more reliance toward consumption tax. Not all. I have various groups on, believe it or not, both sides of the political spectrum that are against this bill because it doesn't go all the way one way or another. I'm trying to be moderated. I'm trying to be phased in and conservative in my approach.
But Kansas is, it appears to be the only state that we can kind of look at that has tried to do what we've done in the last decade. Is that correct?
That's right. And the reason they ran into trouble, among other reasons, is that they cut revenues. They cut tax rates. Excuse me. They cut tax rates without accurately estimating the new revenues that would come in as a result. So essentially, what they did, Representative Pig, is they overspent on their budget because their revenues did not materialize as much as they thought they would.
Representative Williams.
Just a quick question, Representative Carson. You talked about the subset of across the board. I'm assuming that's Fitch, Moody's, and S&P that have all top of the line ratings. What states comprise that subset? I'm sure it's in here, but I hadn't spotted it.
I focused on the S&P ratings. I can find that out.
I'm just curious. So help me, walk me through on the S&P. Then for the contiguous states to Georgia, it's Florida. What other states? North Carolina?
That have a AAA rating?
That have a AAA rating. Just look at our immediate area competitors from
Florida
that
comes to mind.
perspective.
North Carolina, and the only other southern state is Virginia.
So we hear a lot about no income taxes in both Florida, and we know that sunshine drives that state, tourism, and we hear a lot about Tennessee, but it's interesting that only Florida has the AAA bond rating and Tennessee does not, and that's news to me. I didn't realize that.
And if I had to guess, I mean, you have, I want people to keep in mind, if I go back to page 10, because Representative Williamson brought this up, all the way to page 10. We talk so much about the income tax, but there are 4 states on here that don't have an income tax revenue stream and do have a AAA rating from S&P. Now, 2 of those are highly reliant on severance taxes, but 2 more, Florida and Texas. Florida has 0 severance taxes, and Texas is only about 11% of their revenue mix is severance taxes. I would argue that income tax revenues are essential to our AAA bond rating and their stability. But I would also argue, like just as my point earlier, sales and use tax and consumption taxes, as you can see from the data, is more consistent. And really what the credit rating agencies look at, even more so beyond that, based on the reading their reports and their releases, is the quality of our financial management, the diversification of our economy, as well as how funded our pensions and our debt reduction strategies are.
Representative Pack.
Thank you, Mr. Chairman. Representative Carson, you're to be commended for all the work you've done on this. This is actually fabulous. With S&P, I remember I think they gave Lehman Brothers AAA rating before they failed. So I'm not quite sure how much we should rely on S&P and all the rating agencies, for matter of fact. Question for the sales tax. On the states that actually moved towards, I guess Kansas is one, and I think North Carolina did a little bit. On the states that actually moved towards a little bit more of a consumption tax and lower income tax, what effects did they have in terms of kind of collectability of some of the issues we have with out-of-state vendors and things like that? Did you see any data that come out of that?
I did not, and I did not focus on that because what I think you're kind of talking about without naming it is the Marketplace Fairness Bill. I was describing this morning I'm describing it to various other groups in regard to looking at what we call quote-unquote internet sales. Okay, if I may, let's just divide that into 3 buckets. Okay, one is internet access. So I have a MindSpring account or what have you, and I have a digital subscriber, a DSL, and I have access to the internet. Okay, I hope this is really important to understand the portions that pay for our consumption tax in regard to online quote-unquote sales. internet access. We are precluded by federal government from taxing internet access. Second point is online purchases. Okay, so we'd address this in House Bill 386 in regard to quote-unquote e-fairness. I think everybody's heard the example probably 15 times, particularly on this committee, in regard to buying a grill. If you buy a grill from Home Depot, you buy it from Amazon. One's taxable, one's not, previously before 386. With online sales of tangible items, if that vendor that you are purchasing that item from has nexus in Georgia, they are required to collect and remit sales and use tax to the state of Georgia, and obviously ultimately to the localities as well. If that vendor does not have nexus in Georgia, then they are not required to collect, but obviously the user is required to pay. Now, how often does that actually happen on a voluntary basis? Not very often. So internet access is the first part. The second part is purchase of tangible items, whether a vendor has nexus or does not have nexus. The third part, Representative Pack, is intangible items. What I'm talking about in digital downloads, streaming, Netflix, Pandora, Spotify, iTunes, things like that, those are intangible purchases. Whether you have a temporary license, like I'm just watching a movie for a little while, or I have a permanent license, such as I'm downloading Microsoft Office, whatever the latest version is. I believe and 28 other states tax that software as well. Even though it's intangible, it's not because it's not tangible, it's not taxed under our tax code. Even though it is intangible, that's taxable. If you download it, if you just say download Microsoft Office or some other software program like what's the virus protection, Norton. If you were to download that, that's not taxable because it's an intangible purchase. Does that help in regard to the internet purchases?
Right. I was just asking, whether or not those states came up with the. I know we've been struggling with this as a state, and I'm streaming. The question is, I think cable companies in trouble because of that. That's a move towards that. The question is, from a policy perspective, did that have any impact on the other states? Because they already made that change. Did they see any data? And that's one of the things. I agree with you. I think we need to kind of move that. That's an important piece of kind of tax reform because that's our market. But do you see anything that Kansas did to kind of solve the issue that we have?
No, I don't remember any specifically about their consumption.
Representative Duncan.
Thank you, Mr. Chairman, and Representative Carson. I join the other members here and compliment you on the effort you've put forward. This is the most impressive PowerPoint presentation I've ever seen. It's well put together. We may have saved money on the iPads already by not printing all 61 pages. So I think the Kansas model is a really good model to study. And for me, one of the questions I want to find out through this process is the timing of if you time this right in a boom, in an economic boom, the model is easier to thrive in. If you time it going into a recession, it becomes very, very difficult, no matter what the math looks like. So I think one of the questions I want to find out is when did this model go in? Was it into the teeth of this recession that we're just starting to spin out of, or was it in the midst of or on the back end of it? That's a question I need to find an answer to help me better understand the model.
Thank you, Representative Duncan. We have with us a speaker from Washington, D.C. with the Tax Foundation. His name is Joe Henchman. He will be speaking to the issues that Kansas encountered, I hope, as well as the timing. Right, Joe? Yeah.
Chairman Knight.
Thank you, Mr. Chairman. Again, Representative Carson, this is the detail in which and work that you've put into this is really commendable, and this is some great information. I think I want to ask the question, I hope in a slightly different way, and maybe piggyback off of Representative Pack's sort of point there and I go back to the policy part of this. As we looked at transportation this last year, I think we realized that the way that we were funding transportation was implemented decades ago, and that we had enough changes over the years that model, which once worked, we know pretty well, now did not work. So I want to sort of take that same analogy and let's look at this from this tax model that we're talking about, and specifically focusing more in on like you're talking about the digital streaming and you know, you talk about software. As a CPA firm, now we have the option to go purchase a disc and have a disc sent to us, or we can do online streaming and basically, you know, all of our software information is somewhere else within the vendor. Okay, so we've got a change in society that has changed. What do we go back to look at the data of how much has that changed as far as like sales tax? In other words, do we have any more data that would go to show this shift in the change, the digital technology, that would show, hey, if we were really comparing apples to apples, you know, what are we sitting here losing over time, okay, as technology changes, that is eroding a probably once good tax model that we have in Georgia, that should incrementally be eroding that model and making it less and less effective every year.
I appreciate those remarks, and I appreciate the question. I don't think we have data in regard to what have we lost specifically, because what does get reported to the Department of Revenue is an amount of sales and an amount of purchases subject to sales and use tax from a vendor, whether it be Target, Walmart, online, what have you. We get a total amount. We don't get that broken down, and DOR could speak more to this than I can, but I don't believe that they report items that are not taxable.
And Mr. Chairman, I don't know. Let me sort of. I'm just trying to generate the policy question here, because I think as we go to look at what you've done here and what your bill here is that I think we do need to understand how society has changed to such that the model that we have or we've been relying upon is not necessarily the best model going forward. And how do we? This may be something that we work on. How do we quantify that, and come up with that discussion that illustrates to people, you know, this is not going to get any better as technology improves. Part of what we've relied upon for years is eroding, and may continue to erode technology-wise.
Can I point out two items for you, Chairman Knight? More slides. Forgive me. Page 18. Page 18 is the overview of the Communication Services Tax, or CST, reform. And you can take a look at between the blue bars and the red bars. For those of you in the committee, I'm on this slide right here. And you can take a look at what has been the change in just 3 years between what has been remitted as far as state sales tax, local sales tax, and local franchise fees, and other small other fees. And the reason this is occurring is because our tax code is not keeping up with the communications services that are in place today. I would, based on my initial research of Title 48, I think a lot of the communications, taxes, and so forth, that language was probably written in the 60s and 70s. So, for example, this is a cell phone with a Verizon postpaid contract. My apologies to Kevin Curtin. Beverly and I pay the contracted amount per month on this, including the taxes. But there are no taxes on a prepaid phone. So if you go purchase a phone at Walmart for your son or daughter, and you purchase the actual physical hardware, again, tangible personal property, that is taxed. When you go to put another $100 worth of usage on there, that is not taxed, but it would be taxed here for that same usage. The same thing in regard to local landlines. The landline that goes from the old Southern Bell lines, to go from the telephone pole all the way to the house, that is taxed. As far as local calling, long distance calling is not taxed. Text messaging is not taxed. So there's lots of what I would call holes in the code. Other people call it loopholes, what have you. the best way to call it is inconsistencies with current technology. And I think, to your point, Mr. Chairman, that's what we need to address from a policy standpoint. How much is the revenue that we are losing today? I don't know.
All right, we got to move on. I got a couple of more questions. Chairman Rice.
Thank you, Mr. Chairman. Thank you, Representative, for bringing this. It is a lot of work, as we've explored before. The most recent reduction in income tax, I think, was done by North Carolina. They went to 4.6, I think it was from, and I'm not sure where it was before that. Do you know how they got there? And because it looks to me like their sales tax approximately equal to ours, and even I'm not sure 2014 includes the 4.6 or not. But the things that are different are the motor fuel tax, license fees, and stuff like that. Do you have any idea how they got there?
I'm sorry. Okay. You are correct. North Carolina implemented reform, I believe, Jeremy, I think it was in 2013. Is that correct? Yes, sir.
Effective for 2014.
I believe that's correct. One thing they were in an environment. They had an environment where the top individual income tax rate was at 7%, and they had a tiering system, much like we do now. So, for example, if Tom and his wife Rice made X amount of money, the first $2,000 as a married couple, you'd paid 1%. The next $2,000, you'd pay 2%. The next $2,003, and so forth. That one thing they did was a major factor was to eliminate those tiers and go to a flat rate, fair rate for everyone. Second, if I remember correctly, they did away with a lot of income tax credits. And one of the things they did away with that I do not propose doing away with is film and entertainment type of tax credits. That they were able to lower their income tax rate. As a result, having said that, they essentially lost that industry. The third thing they did is they were able to raise their standard deduction and eliminate exemptions, eliminate itemized deductions for a number of certain items. I know one of them was medical expenses, and go to a flat standard deduction over all taxpayers.
So it would seem from that analysis that my guess is that the progressiveness of the income tax rates is what led to the big increase in revenue, not on rate, but on you can reduce the rate, but effectively almost increase the revenue based upon the flat rate as opposed to the progressive nature of the rate.
I don't know how much their year-over-year revenue changed. I do know that that's how they paid for a rate cut from 7 to 5 3/4, 25 basis points less than us.
Okay. Thank you.
Okay.
26 is
Chairman Reinders.
I'm sorry, I actually covered that in page 47 of what I did.
Thank you, Mr. Chairman, and thank you for the hard work you've done on this. I've always been of the opinion that the broader the base of collection, the less pain all of us have. We know that, and I don't know if there's other states, and I'm just asking you, we know that there's a lot of money and revenue out there in what's called the underground economy, dealing with cash, some legitimate, some not. Politically, a lot of people feel like they don't pay their fair share, whoever they may be. Did you look at that in any way, have discussions with the Department of Revenue instead of, and I get people that feel like they're overpaying on their income and they're like, it's like I'm being penalized for succeeding. What did you do to look at perhaps not just what's currently taxed from a consumption, but even services? Did you look at any of that to try to catch people that others would say aren't paying their fair share?
Okay. Yes. I had a discussion with Commissioner Riley. I believe she was going to be here today.
She's here.
Okay. When we did the modeling with the Carl Vinson Institute, they put in estimated avoidance for various factors, one being income tax, a second being sales and use tax. Actually, there was some other avoidance from other categories as well. That avoidance that I remember was in the single digits. I can't remember exactly. But when I spoke to the Department of Revenue about your specific question, Representative, the issue is they can't exactly quantify it, because if they could quantify it, they'd be absolutely going after it. Okay, so if you had $100 in sales and use tax revenue, and it really should be 105, well, they would know exactly what it is, and they'd be going after them and so forth, with whatever means they have to do so. So I asked for that quantification, and that, as I understand it, the DOR will be speaking as far as one of the speakers. Perhaps they'd be better suited to answer your question there. The second, if I may, you asked about services. Services are not part of this tax bill. Okay, so we are not taxing lawyers, accountants, doctors, engineers, architects, anything like that, because the last thing I want to do is introduce a jobs bill that moves jobs out of state. Particularly,
and I understand that, but for the people, and my point there wasn't necessarily in the accounting or the attorneys. I've watched that movie before here several years ago, and I don't want to see the rerun. But for the people that perhaps aren't in that kind of realm, that I'll be more than happy to talk to you about, that are providing other kind of non-professional services. I just want to make sure that what we're doing is we're trying to go after people that mine and your constituents would feel like isn't paying their fair share. So that's what I mean in the totality of that kind of questioning. I remember a couple of years ago where we had a bill where we wanted to say you couldn't use EPT cards for piercings or tattoos and things of this nature. So that's what I'm kind of looking at, not those that are paying their fair share, but what are we doing to make sure we're making it even broader.
I think the answer. Thank you for that. I think the answer to that question is better suited for Department of Revenue and their representatives that I see are here today. And second, I didn't mean to just talk about professional services. Any services whatsoever are not within this tax bill, except for communication services.
Thank you.
Okay.
All right, we're going to move on because we've got several other speakers and we want to make sure that we have a chance for questions for them. So I'm going to ask Joseph Henchman of the Tax Federation to come up here and maybe take a seat with Representative Carson. And for the members of the committee, while he's coming up, the way that we've arranged for these iPads is that they belong to the Ways and Means Office. They will be available loaded with information for each meeting that we have. And so if you want some of this information between meetings, because certainly there's a wealth of information, what you will want to do is you will want to forward these emails to your personal account, so then you've got access to it at any time. So during the meeting, if you want to do that, I would suggest you be doing that before the meeting's over. Zero 133.
It's a hot seat up here. Be careful.
It is the room number for the Ways and Means Office.
Thank you, Mr. Chairman. Ready?
Tell us a little bit about yourself, Mr. Henchman, then
Sure.
get into your presentation.
So my name is Joseph Henchman. I'm Vice President for State Projects at the Tax Foundation in Washington, D.C. And we're a nonprofit think tank. We've been around since 1937, and we work on provide tax data, research, and analysis at all levels at the federal and state governments. So far this year, we've testified or presented or consulted or analyzed in about 25 states. It's been a very busy year for taxes. And then we've been active in a number of the states that's been mentioned already. And Mr. Chairman, if this works for you and for the members of the committee, I'd like to talk a little bit about Georgia's tax system in a national context compared to other states, and then do a little bit of discussion of what North Carolina did and what Kansas did, because I know those questions have come up. Is that amenable to you, sir? All right. What we've just handed out, and thank you so much for handing that out, is we call it a one-pager, even though it's really 2 pages of information on Georgia. And just starting from the side mark, Georgia's taxes at a glance. It provides just some basic information of Georgia compared to other states on the different rates, the different tax rates in the state. There's one I want to draw your attention to, which was the main subject of the hearing, which is the sources of state and local tax collections. And that's in that first column on the kind of the second one down on that first column there. And that just provides a context of Georgia's mix of revenues compared to other states. Property tax right on the U.S. average there. Individual income tax, Georgia relies a little bit more on it than your average state does. Corporate income tax, Georgia relies a little bit less on it than your average state. And then sales tax, Georgia relies more on it than your average state. And then everything else, other taxes, Georgia relies on less. That's not to say that what the average of all other states does is ideal or desirable, but it just provides a bit of contextual information for how does Georgia's revenue mix compare to other states. On the other side, tax facts and comparisons Georgia. We just have some comparisons from some of the reports that we do. So that middle purplish dot there, that's the state and local tax burdens report. It's a calculation of how much people in each state pay in state and local taxes. So we add them all up and divide it by income and compare the different states against each other. The most recent one we have is from 2011. There's a bit of a lag in the data availability from the United States Census on the information we put together. But at that time, Georgians paid 8.8% of their income in state and local taxes. That's 35th highest in the country and below the national average of 9.8%, but higher than most of Georgia's regional neighbors there. Tennessee 45th, Alabama 41st, South Carolina 42nd, below Florida at 31 and North Carolina at 17. The blue dot next to it there is the State Business Tax Climate Index, which is a report we put out each year where we look at how states collect their revenue. This is a look at state tax structures because there are, from an economic perspective, from a research perspective, better and worse ways to raise a dollar of revenue. There are some ways of raising tax revenue: hurt economic growth, discourage investment, encourage distortions in the economy, and others don't. And we look at over 100 different variables comparing the states against each other on that. In the areas of individual income tax, corporate income tax, sales tax, property tax, and unemployment insurance tax. And the ranks for Georgia and for neighboring states are provided there. I thought it might be helpful at this stage to discuss North Carolina and Kansas, just to put some of that information in context. And I'm sorry, I do have some more handouts on this. So as was mentioned, North Carolina enacted a comprehensive tax reform in 2013. We consulted and advised as part of the process. And this was the book that we produced as part of that effort. If I could draw your attention to page 50 of that book. This gives you a little bit of the context of why they tackled this. So page 50, 50. They had had a bunch of tax reform commissions and reports and recommendations over the years in North Carolina, and many of them had common themes, which we've kind of collected here together, that were never really acted upon. So the state was still kind of relying on the tax system that had come about in the post-war era and never really comprehensively looked at it for reforms or for changes. They had a number of other challenges that drove them to do what they did in 2013. There were some good elements, of course. They have a very strong and diversified economy. They have significant net inbound migration. They have growing personal income, but there were also challenges also. If I could draw your attention to pages 14 and 15 of the book, you can see some of these depicted in these graphs we have. So on page 14, gross domestic product per capita in North Carolina, lower than the United States and growing, that gap growing. On page 15, unemployment in North Carolina used to be below the national average, and then it had flipped and was then above the national average. If you just turn back one page to page 13, this was a significant source of concern in North Carolina, which was although personal income was growing, it was not growing as fast as the U.S. average. So North Carolina had a bit of a peak in the early 90s for their personal income as a percent of the U.S. average, and then began falling off. Georgia is one of North Carolina's neighbors, also on this chart, and actually faces a similar phenomenon. Georgia's in the green line there, that's just above North Carolina for a little bit of that period. And in producing this book, we talked with, I'd say about several dozen representatives of various associations and trade groups and organizations in North Carolina, and a sense that we got was a bit of incentive fatigue. So a lot of what North Carolina's economic development was doing was relying on industry-specific or business-specific incentives, rather than comprehensively looking at the system as a whole. And they got burned on a couple of them. A plant was built with incentives, and then as soon as the incentive ended, they departed. And there was a sense that wasn't producing the outcomes that they wanted. So there was a desire to do something different. And I'm from the Tax Foundation, but I do want to admit, I guess, that taxes are not the only thing that matter for economic growth or for state success. There's lots of things that matter. Lots of things go into decisions by individuals or businesses on where to locate and where to expand and where to invest. There's having an international airport is something that appears on a lot of lists. Having a well-educated population appears on a list. Having good transportation infrastructure appears on a lot of lists. And I've even seen one study that suggests that where the CEO's wife wants a company's headquarters to be has a statistical significance on where that ends up being. But taxes certainly matter too. And taxes play into these decisions by varying degrees and at different times for different people, but taxes are part of the mix. And we've put together a report, which I did not provide because it's not the most exciting reading, which is a study of studies, a look at every study that's ever evaluated the impact of taxes on economic growth. And so it's a study of studies. And overwhelmingly, there are some exceptions, but overwhelmingly taxes affect economic growth and affect decisions. And in at least the kind of general consensus, especially driven by OECD research over in Europe, is that business taxes and income taxes have the biggest impacts on economic growth, sales tax and property tax less so. So there was a desire to do something in North Carolina, and the same themes kept coming up. The franchise tax was a problem. The high individual income tax, which was 7 3/4%, was a problem. The incentives, not only not getting the economic development they hoped for, but also a sense of unfairness from homegrown businesses that were expanding and weren't getting the incentives that were being granted to businesses lured into the state through those programs. And then the sales tax base was a problem. The first state to adopt a sales tax was Mississippi in 1930. And they adopted a sales tax that reflected the economy of Mississippi in 1930, which is primarily agricultural, almost entirely goods, not really much services to speak of. And states doing what states tend to do, they copied what Mississippi did in 1930 when they began setting up their sales taxes. And that's why we see a lot of states in the United States with taxes on goods, exempting a number of goods, and then not really a lot of taxes on services. And this would be fine if our economy remained resembling the Mississippi economy of 1930. But of course it hasn't. Services are a much larger share of the economy today. In most states, over 2/3 of the economy or higher. And the sales tax has not kept up with that. So a sales tax premised entirely on a shrinking share of the economy has caused issues for long-term stability for the tax. And you've seen states deal with this by raising the rate over time. So sales taxes, when they came in most states, came in at 2, 3, 3.5%, but you see states raise them over time as that base has not kept up with the overall growth of the economy. So what did North Carolina pass? Sorry, another hand up. And in the interest of time, I'm skipping past all the good stuff, which is the back and forth of the legislative process, because I just skipped from January to August.
That'd be good if you can kind of keep moving. We got several
July,
other
yes.
speakers, so that'd be good.
So what did they end up passing? They flattened and lowered their income tax rate from 7.75% to 5.75%. They increased the standard deduction for all taxpayers. They capped itemized deductions except for charitable deductions. They reduced the corporate rate to 5% and wrote in what is called a trigger in the public policy community. That is a goal was set on revenue for the next several years, and if revenue exceeded that goal, the extra money was used to further lower the corporate income tax rate. So this year, for instance, they met that trigger, and the corporate rate will fall to 4%. And it's there's a further trigger to bring it down to 3% if revenue meets the goal in 2017. The estate tax, they still had estate tax, was repealed. There was some sales tax broadening to service contracts, admissions, so movie theater tickets and so forth. Some of those were subject to lower or no sales tax, while all other transactions were, and so those were brought into the base. The sales tax holiday program was eliminated. The film tax credit program, as was mentioned, was converted to a grant program. The earned income tax credit was eliminated. Overall, a net revenue reduction of $700 million out of a $51 billion budget pie.
Mr. Hinchman, let me.
Sure.
North Carolina did not expand the sales base at all?
I'm sorry?
North Carolina did not expand the sales base at all for sales tax?
There was a little bit of base expansion, but it was not significant.
Okay.
As I mentioned, service contracts, admission tax, both that and the franchise tax reform were kind of bracketed for something to deal with in future sessions. And in fact, their budget session is still ongoing, and those are two of the big topics that they're considering
Just
now.
want to be clear about that.
Yeah.
Yes.
Yes, sir.
You keep referring back to property taxes, and I assume that when you mentioned budget numbers in North Carolina, you were talking about the state budget numbers.
Correct.
I do want to make sure you know that Georgia, as far as our state budget, we've gotten out of the property tax business.
Yes.
You do know that. So I know these figures are showing that. That's only at the local level, so I'm, keep switching from state budget numbers to the state in a whole, but I want to make that distinction.
That's a very important point. I thank you for bringing that up. And what I've been talking about in North Carolina, that's been strictly discussing the state level reforms, in which they didn't do anything on property tax. The handout that I provided, this one is state and local combined. North Carolina's tax reform was contemporaneous with their reform of their unemployment insurance system, so it's difficult to tell. It will be difficult to separate which one of those affected things more. But overall, we've seen revenue go up, unemployment drop significantly lower than the national trend, so it's been kind of deemed a success. The key things I think that the North Carolina reform signaled was that the state was open for business. It's looking for ways of making sure its tax system is pro-growth and pro-investment. It was comprehensive. It was not an industry by industry or targeted a certain collection of businesses, but it was all taxpayers, all businesses were subject to the reform. And it was structural. It was balanced as part of a number of other initiatives, such as the UI reform and in other areas, to address what the new legislative majority wanted to address compared to what the prior group had done. And that, I think, is the key difference between what North Carolina did and what Kansas did. And from the very beginning, I've been very critical of the Kansas approach and what Kansas did, and I can send you any number of almost pleading op-eds that I've written over the last several years since Kansas has undertaken what they've done. The main flaw there are two. One, there was no real effort to structurally account for what they were doing with the rest of the budget process. So they set a goal to eliminate the income tax, and they wrote it into law, but really didn't plan on what they wanted to do, how they were going to balance the budget given that revenue constraint they were putting on themselves. And then second, they added a special tax exemption for pass-through businesses. So if you've got Schedule C income on your income tax, all of that was suddenly completely free of tax. And that created both a significant revenue drop, and indeed a one beyond what they anticipated, and significant instability in their ability to predict revenues, because at least anecdotally we've seen a lot of evidence of people transforming their business form, people who can, usually well-connected people or higher income people, converting their wage income into pass-through income to take advantage of this new loophole that's been written. And in fact, I'd put a significant part of the problems that Kansas has faced at the doorstep of that particular policy decision. So if that's something that Georgia is considering, I would think very hard before undertaking a special exemption for pass-through businesses. There's, of course, many other states that have undertaken things over the last several years. Indiana has reduced individual and corporate tax rates. They are another member of the S&P AAA bond rating for many years club, along with the state of Georgia. Texas just this year voted to reduce business taxes. They, of course, have also had AAA rating for a number of years. Rhode Island's voted to reduce individual and corporate income taxes. New York did a big corporate tax reform last year. Michigan did a significant reform of business taxes. And then in the District of Columbia, where our office is, left and right came together on a package of reducing individual income taxes, reducing business taxes, broadening the sales tax a little bit, and making the tax system more progressive. I know there's a lot of competing interests in states that consider tax reform. There's a lot of disagreement over what goals can be, but there are ways of making them complementary and bringing them together to achieve systems that are fair, pro-growth, and structurally sound. Well, with that, Mr. Chairman, I'm happy to take any questions that you might have.
Are there questions? Representative Peake.
Thank you, Mr. Chairman. Thank you, Mr. Henchman. Just on behalf of the governor, I'm just going to make a quick statement. It's interesting. I would take exception to the fact that we're 36 out of 50 states on a tax basis when we consistently have been, if not number one of the top 5 states in the country of where to do business. So clearly we're doing something right, whether it's the tax code, whether it's those other intangibles that you mentioned. Sure, they all add into the mix, but we clearly have a tax system in place that provides for stability, for management of the debts of the state's debt for years to come, provides a pretty darn good incentive based on a track record of the last 6 years of businesses coming to our state and wanting to come to our state, as well as population growth, citizens coming to our state as well too. So I would take exception with that because clearly we're doing something right, and from a tax code standpoint and other intangible factors as well too. So
that's a very good point, and I certainly have no disagreement with that, in that we are the tax foundation and we focus on taxes, and there are many other studies and many other analyses out there that look at some of these other features that you're talking about. I will note, however, that past performance is no guarantee of future success.
Sure.
And the level of competition and that we're seeing now in our new globalized environment, where capital and people and investment can go pretty much anywhere in the world that it wants. And having a competitive tax system is part of that equation. And there's different ways to do that. I mean, we consulted with New York on their corporate tax reform that they did. And New York raises a lot of money from corporate income taxes, I'm sure you imagine. And it will continue to raise a lot of money from corporate taxes. But that doesn't mean that they need to raise it in what at least we consider to be a unwise method. So before the reform, New York imposed 4 different ways of calculating the tax. You had to calculate all of them and pay the highest. There were 2 different systems, one for banks and financial entities, plus some extras, and then there was a system for everybody else, 2 different entities enforcing it, 2 different sets of rules. There was an alternative minimum tax. There were net operating losses that did not rules that did not match the federal, and of course the state was different from the city. Right. They've fixed all of those things, and I think they'll be better for it. And those are the kinds of things that our ranking looks at. So while I have no doubt that, and I certainly see that Georgia is succeeding, that doesn't necessarily mean that it's hit a ceiling on what it can achieve.
Sure, and I think the governor's position is we'll look at anything that makes good sense for our state, but we just got to make sure it keeps us in a prudent financial position to make sure we are committed to the obligations we've made to our taxpayers as well too. So
I'll say that I certainly share that commitment.
Yep.
Let me ask you a question as far as North Carolina is concerned. The tax changes that they made were made in 2013, is that correct?
Yes, some of them took effect that year, some of them took effect in 2014.
Okay. So we've really only had 1 year of everything being in place, is that correct?
Correct.
And one thing that we have seen as a result of that is a adverse impact on the movie and TV industry part of what was in North Carolina, correct?
I believe that is correct. A lot of the large studios have reduced the amount of filming they do in North Carolina. I don't know the impact of some of the smaller, independent, more local entities because they're still eligible for the grant program. But the large studios that come into the state for a couple of weeks and then leave, North Carolina's seen less of that.
My question is this, having sort of prefaced it with that statement. How long is it that you give a change before you feel like that it has shaken out? Because some people, may say, I don't like it, but they don't really realize that it has hurt them for a year or 2 years or 3 years to the point that they're either willing to make a change or they increase employment or decrease employment. How long does something like this have to be in place before you feel like that you can fairly judge any kind of tax change like that?
That's a very good question, and I don't know if there is an answer for it. I think you've got to constantly monitor things and constantly evaluate as evidence comes out. So Minnesota passed a new tax on warehousing services. It was a very high tax, and before it went into effect, you had a lot of warehouses getting together plans to move out of the state. And just to give you a sense of how punitive this tax was, that it was motivating warehouses to relocate out of the state. I don't think you needed to wait too long to figure out how destructive that particular policy was. For other things, maybe you do need more time to evaluate, but I think you've always got to look at the evidence as it goes, but sometimes there are calls you can make on what's good and what's bad tax policy, so as I've done with Kansas.
Okay. Are there any other questions? Thank you, sir.
Sure. Thank you.
Dr. Tutterow.
Thank you, Chairman Powell, members of the Ways and Means Committee. An honor to be with you today to offset my friend Representative Carson's 61-page PowerPoint. I brought along the 97-page report from the 2010 Special Counsel on Tax Reform and Fairness. I'll make the books on tape version available to you afterwards.
Are you saying you worked harder?
Hardly. It's definitely not as pretty as yours either.
If I may interrupt you for a second, for your leisure reading, I think that's on your iPads.
Thank you, Mr. Chairman. I thought I would spend a couple minutes sharing just a couple quick ideas and then take any questions as homework to get answers and bring them back to you if so desired. As I alluded to, in 2010, it was my honor to serve on the Georgia Special Counsel for Tax Reform and Fairness. It was an interesting process. I do think that process is the way to think about it. While some of my colleagues might have been a bit disappointed that recommendations were not adopted wholesale, quite candidly, I thought that was probably not realistic from the beginning. I thought that my view of the political process is that we over time evolve, and as Dick Darman once explained to David Stockman, the political process gets nudged along one little miracle at a time. And so I view what we're doing today as a continuation of a candid review of how we collect revenues in the state of Georgia. I did want to kind of point out two things from 2012 that I thought, or 2010, that were worth acknowledging. First, I do believe that the 5 principles that we adopted at the beginning of the tax reform, that is, that it should be growth enhancing, that it should promote efficiency and minimize economic distortions, that it should be stable, that is, we need to incent the economy to have less volatility in the tax revenues, that it is, of course, fair and equitable, and also that we have clarity, that we have a tax system that allows businesses as well as citizens to understand how the revenue is collected. From that reform, there were essentially 4 things that came out of that, 4 recommendations that we brought forward that in some form took the place of policy. First and foremost was the sales tax exemption on manufacturing, mining, and agricultural interests in the state. I am unqualified in saying I believe that the wisdom of the General Assembly and the governor in supporting that has been a game changer for economic development. There are goods producing facilities around the state of Georgia that likely would not have located here had they had an additional 6% to pay on their cost of energy. So I commend you for the vision in bringing that forward to actual policy. We recommended looking at the motor fuel tax and moving it toward being a per gallon charge, which of course July 1st we went into that framework, and I think that will show out to be a positive move in terms of policy. We also made recommendations about how we handle taxation on title policy, including automobiles, which of course we changed how we collected the tax on that. And then of course our recommendation to set up the tax tribunal, which is of course now in play. So I thought I would spend just a couple minutes too commenting on 1 or 2 ideas I would share as an economist thinking about tax reform in Georgia. On March 19th, I had the privilege to appear with you, and at that time I emphasized really one big point, which was the big difference between doing tax reform at the federal level versus doing it at the state level. Because some of my dear friends that are even with my political persuasion like to draw parallels between how things are done at the federal level and the state level, and that's just not always correct. For one thing, we have acknowledged that we in Georgia cannot run a deficit. We can plug the gap for short periods of time with our rainy day fund, but because we can't run a deficit, we can't cut tax rates and wait 2 to 3 years to see if it has a stimulative effect upon our economy. Therefore, our changes in tax policy need to be a little bit more gradual, because I always caution against overstating the precision with which we can estimate the implications of tax changes for their fiscal, for the revenues that we generate. The other big point, and this is one that we spent a while on in March, and I think really was essentially attested to today as well. State tax reform and federal tax reform work in a different way. Federal tax reform can be pro-growth through changing the incentive structures in the economy. When I cut individual income taxes at the federal level, it changes the work-leisure decision. It changes whether or not we invest in entrepreneurial ventures, whether we invest in risky assets. At the state level, the state burden, for example, on income tax is low relative to the federal burden, so the real effect of state tax reform tends to be spatial. That is, it tends to enhance or harm us with regard to our position vis-a-vis surrounding states. So because of that, I think your comment, Chairman Powell, with regard to how long it takes for tax changes to show up in terms of economic activity and in terms of revenues coming in was very, very poignant. Because when we talk about decisions about where individuals locate, where businesses locate, which facilities they expand, we have to acknowledge that those decisions sometimes take not weeks or months, but years, and in some cases, perhaps even a decade. So some of the decisions that we make today with regard to how we do taxation in Georgia will not fully implement in terms of tax revenues in the nearest term. Today I'd like to touch on 4 quick comments that I can make, and then we can take some questions if that's okay. One is, obviously by my appearance, I affirm the principles that the Tax Reform Commission adopted in 2010 that I outlined earlier. I believe they're as relevant today as they were 5 years ago. I come to reaffirm the important distinction between taxes on business inputs and taxes that are collected on the final consumption of goods. When we talk about sales tax in the economy, it is crucial that we do not have sales taxes levied upon business inputs, what formal economists like to refer to as the pyramiding effect. So that is why the reduction of the sales tax or elimination of the sales tax on energy, mining, and agriculture was so important. So while I encourage the General Assembly to look at broadening the sales tax base, I also would encourage them to embrace the exemption of the taxation of business inputs, because going forward, I think that is imperative if we're going to continue to maintain our position as being a pro-business state in the Southeast. Third, I would like to comment that I support broadening the base. I certainly understood our question that we had earlier, that while this proposal does not directly talk about broadening the base on services outside of communications, one of the things that we advocated in 2010 was to add the sales tax to certain components of services, not all of them. We didn't expect sales tax to be levied against legal services and accounting and things like this. What we thought, though, we could do is to identify businesses that already had in place the mechanism for collecting sales tax on the goods they sell. For example, I go get a haircut. If I buy shampoo and conditioner, I pay sales tax on that, but perhaps not on the actual cutting of the hair. The second thing we looked at was to try to identify those businesses who needed to be in close proximity to their ultimate customer because they are less likely to relocate outside the state. So when we do think about services, I think there is some room for us to talk about broadening the service base against which we pay sales tax, and then perhaps using those revenues to fund the buying down of an income tax or some other pro-growth measure over time. I would also kind of point out that we did suggest that the General Assembly consider imposing a sunset on sales tax exemptions at the retail level, and my reason for that is simple. We have decisions that be made perhaps in 1990 that we look at in 2015, 25 years later, and we've lost the catalyst for why they were so important at that time. So rather than see our tax code burdened by legacy effects for decisions that were made in many cases decades ago, a periodic sunsetting that would allow the General Assembly in its wisdom to extend that credit going forward would provide a mechanism by which we could get to a broadening of a base without having to go through the cumbersome process of identifying each of these and dealing with, quite candidly, the political fallout that comes with removing these exemptions in some times. Finally, let me comment on a couple things that I did hear today. On the North Carolina tax cut or income tax adjustment, I would like to acknowledge that while it is true they moved to a flat rate as opposed to a tiered rate like Georgia has, but let's want to keep in mind that because we have an exemption, because we have individual and itemized deductions, the first percentage of individuals' income is essentially free of state income tax. So even if you have a flat marginal tax rate, it is still a progressive tax because as your income goes up, the percentage that you pay of your income on tax still increases. So we don't want to confuse a flat income tax in the presence of an exemption or a deduction with being truly a flat or regressive tax. I would also comment, again, as I have already, on the services in support of broadening that base. And then finally, on my friend, the distinguished gentleman from Macon, Representative Peake's comment, I too celebrate the fact that Georgia has for the last several years been at the top of the list with regard to business environment. One of the things, though, that I caution us about is when we look at these lists of the top states in which to conduct business, they are overwhelmingly concentrated here in the Southeast. At one time when we were ranked #1 in the nation, of the next 12 states on the list, 10 of them were in the Southeast, including almost every state that touched us. So part of the problem that we have is although Georgia has a very pro-business environment, is seen as a great location for locating business, that's also somewhat true of the southeastern states around us. So while it's good to benchmark ourselves against California or against Illinois or against New York, the real battleground is us versus North Carolina versus Florida versus Virginia and Tennessee. And that would conclude my 5 to 10 minutes of comments and field questions.
Representative Peake.
Thanks, Mr. Chairman. Dr. Tudor, as always, that's good stuff. You got good insight. In fact, I want to push you a little bit on one of those insights, though. Your assessment that the impact of changing the state income tax or broadening the base may not have as much incentive to recruit business here and has a smaller impact. I may not putting words in your mouth, but I may not have as much incentive as making an exemption for retirement income or a film tax credit. Mm-hmm. That's an interesting observation, and so it begs the question: does it really matter what we're doing here? I mean, whether we reduce the state income tax 0.25%, 0.5%, and broaden the base, is that going to make a difference really? on whether a business decides whether to come relocate here, because the percentage is so small compared to a state income tax, a federal tax obligation. And so, if you would, I'd love to have your observation on that potential assessment. Does this really matter fundamentally to whether businesses will come here, whether we tweak this a little bit as compared to tax incentives that might have a direct impact on a business coming here and bringing good jobs?
Right. Thank you, Representative Peake. And let me clarify my comments a little bit. What I was trying to address is if we think about reducing, for example, an income tax in Georgia by 1%, you would effectively be cutting, if you use a 6% rate as the highest marginal rate, you would be reducing the tax rate by 16%. So you're not going to get enough additional economic activity from individuals altering their behavior to close that revenue gap. Because the individual looks at a federal tax rate of, let's say, 35%, 6% in Georgia. They just got a 1% reduction in their Georgia rate. That's what, 141st? That's about 2%, less than 2%, a little bit over 2%. Where the state and local taxes matter is where people decide to locate, more so than how they alter their individual or microeconomic behavior. I do believe that entrepreneurs make the decision at the margin about where they locate based upon tax treatment. Back in 2001, when we had 6 meetings in which we invited groups to come in, several entrepreneur groups, including those that worked in the technology sector, said to us, we really don't care that much about the corporate income tax. We decide where we're going to locate based upon the individual income tax, because we know there's going to be a day where we're going to sell that company, we're going to realize that income, and we want to be in a low income tax state on the day that we sell the company. So I do believe it matters for where people locate. It is a long-term play, but I think that the traditional way that we talk about tax reform at the federal level, which is incenting people to work, take entrepreneurial risk, is probably less of the catalyst at the state level. At the state level, it is more about where we take those risks and where we work.
Yeah. Okay.
Chairman Rice. Thank you. It's kind of a follow-on to that question, because back to your business inputs issue, and I've forgotten from the 2010, if I ever knew it, what those inputs were and what the effective impact it would have on the issue we're talking about here. Particularly since you just kind of countered that on this other comment about the entrepreneurs favoring a personal income tax, low personal income tax. Tell me the effect of the business input taxes and the how we could change that.
Right. What we like to do as economists is we like to have tax schemes that create minimal distortions. That is, we don't want to alter the relative prices of activities or goods or services. And one of the concerns about having taxes on business inputs is that if I tax you on the input going into the business, and then I tax the product when it finally goes to market and gets purchased, you've got pyramiding, because the cost basis in the production of the product includes a tax as well as a tax on the final sale of the good or service. So one approach to it is to say we're not going to tax business inputs, and instead we're going to capture the revenue when the product actually goes to market. The exemption for energy sales tax was a great example of that. So that was probably the most tangible example of that principle leading to a shift in policy. But I think more broadly, we should always look at taxation upon business inputs and say, does this have the potential to lead to pyramiding, which alters the ultimate price in the market for the good that is provided?
Just to follow up, Mr. Chairman, for a second. But in your report from 2010, did you list the effective hierarchy of those business input taxes, and was the energy tax the one that grabbed the most opportunistic number?
Well, we were very explicit about the energy tax. We outlined the general principle for the business tax, but I think that was the one that we most aggressively targeted. We were not working in isolation. The Georgia Chamber, had it as their policy position as well. I think Governor Deal was campaigning at the time, and he had come forward in support of it. But that was the one that we identified, and in large part because the goods producing side of our economy, has some pretty strong choices to make about where they locate, particularly if you think about mining or if you think about manufacturing firms. And so we wanted to improve Georgia's position with regard to manufacturing because we have seen how it has decimated the less urbanized parts of the state when a single manufacturer has left communities.
Chairman Knight.
Thank you. Dr. Turo, once again, for the work that you did and continue to do in this regard. I personally think you've added a lot of value to this. I want to go back to my question that I originally had asked with Representative Carson, and maybe you can lend some either any data that you may have or help us start thinking about that. I still go back to a changing world, and at least that segment of you know, the tax, you know, how we were doing it, the method of taxation, a changing world, changing technology. You know, how can we start quantifying that? There is a change. Mm-hmm. Okay, so how do we start analyzing what as technology has improved, and we're getting things, you know, online, so to speak. There used to be a sales tax. Okay. Right. If we went down and we purchased software, you know, you paid a sales tax. If we went and purchased a video or a cassette, you know, or a CD, there was a sales tax. Okay. What are we losing? In other words, how do we start to look at, as if we keep on this road, the sales tax is going to keep going down and down and down. So we can't rely on where we are here. And I'll make a second point. And I pointed this out in the previous gentleman that was up. While the state is not in the sales tax business, okay, we've gotten out of the sales tax business. I mean the property tax business. The local governments still are relying on sales tax, and I think, Representative, we've talked about this. And you know, a part of that sales tax is a rollback, and in other words, it does affect property taxes. And I can tell you that I think, or at least in my mind, property taxes are an issue with companies and with people locating to our state, maybe versus other states. So I think this whole issue, that's where I'd like to maybe any comments that you have, put those two together, and then maybe anything that you could help us going forward, start to try to analyze and keep up with this to see if we can get some data that would help us.
Yes, Representative Knight, great question. And on property tax, it is interesting because we tend to think of them as being upon residential abodes. And, you know, in some counties, you know, DeKalb County being one of the earliest ones to do this, actually added a sales tax and used proceeds to roll back residential property taxes. Because most studies show that property taxes are not terribly popular with the electorate. The issue, though, too, is a business issue. And if you're thinking about where you're going to locate a large facility, the property tax that you're going to pay, it can be a decision that there can be a factor that impacts that decision. I do think that some locales have used property tax abatement as an economic incentive to try to entice people to relocate there. So I think it is fair to acknowledge that role. But I also would comment on your first point, which is as the economy changes, what are the implications for tax revenues? And I'll contrast it with a challenge and something we did right. The something we did right was with how we changed the fuel tax earlier this year. When the General Assembly changed the fuel tax to move it to being strictly a per gallon charge, we also had indexation with it to take into account the fact of higher fuel efficiency would mean that you would collect less revenue, although people would still be using the roads. You also had an indexation for inflation. In so doing so, they made a decision to redo the tax in a way to where down the road we would not have to revisit this periodically. Because part of the problem we had with the fuel tax is that over time, increased fuel efficiency meant that the amount of revenue coming in to finance our road program did not grow in proportion to the needs that we had. The contrast to that is with services. As the economy continues to be more and more of our products being service or being service as opposed to goods, that means less and less of the state's output is subject to the sales tax. That's a trend that's been going on for decades, and it's one one that's unlikely to abate. And then the third point, as you acknowledged, is over the last 15 years, as increasingly the internet and e-commerce have become issues or become a larger part of the retail sector, because we don't capture sales tax on that, that also is an erosion that we see in terms of our ability to collect revenues in line with the pace of economic activity.
I have a question. Change gears a little bit. My concern is that theoretically, a lot of people agree that moving to a consumption-based system, or at least moving in that direction versus an income tax-based system, might be advantageous. My concern is that nothing happens in a vacuum. And right now, for instance, under Georgia's tax code, you've got seniors that are able to deduct retirement income. Mm-hmm. So an income tax deduction really does not benefit somebody whose income solely comes from retirement. And yet, to offset or to allow that, we have increased consumption taxes by going from 4 to 5%. We tax digital downloads, or we do whatever it is. Mm-hmm. Part of the proposal is that we take off the exemption off of groceries. So if you consider that, say for seniors, you consider the tax incentives that we give to businesses to move to the state of Georgia, or to expand in Georgia, or to create jobs in Georgia. And you say, we are going to give you X number of dollars of income tax credit if you create jobs or you do capital expansion. And then we reduce the income tax, we reduce the impact and the viability of those kinds of incentives. So it's not just a vacuum that we're dealing with. There are contrary repercussions from that, and I'd like for you to comment on that, please.
I think, Chairman Powell, you're obviously right. One of the things we haven't really articulated is that in most tax reforms, there are winners and losers. It's kind of hard. Even if you decide that you're going to be revenue neutral, which is what we did in 2010 as a pledge, if you're raising tax on one individual, someone else likely will feel if you're cutting it for one group, you probably will be raising it somewhere else. And you're correct in saying that if you were to raise the consumption tax, there would be individuals for whom the increased sales tax collections might exceed the reduction that they have in their income tax contribution, the seniors being an example of that. And certainly that's something we have to acknowledge. And typically when you do fiscal notes at the federal level, and we may do that sometimes here at the state level, we look not only at the projection for how much revenue would be generated, but you may have a distributional analysis that shows how it hits individuals in different income strata. And also the same may be true if you wanted to look across demographic groups. And that is, of course, always one of the problems. And it's hard, I think, to not make hard choices about policies that are designed to promote growth and job creation in the state without acknowledging that in the short run, at least, there will be some people for whom the burden may well be increased. When I speak to groups around the state, and occasionally tax reform will come up, having served on the commission, I like to point out that the sales tax on food was probably not our greatest Dale Carnegie moment. It probably did not make us too loved with many parties, and I understand the reality of that increase. So I think what I've tried to do is always advocate what I thought was best from an economic efficiency perspective, but understand that there are equality issues and fairness issues that you guys also bear the burden of balancing out.
Okay, thank you. Representative Pack.
Thank you, Mr. Chairman. I want to piggyback on what you said. I'm trying to understand. You said there was enough tax break, a decrease in income tax rate does not generate enough individual economic activity to justify. I missed that second part of your statement.
Just now in response to Chairman Powell's
No,
question,
during your presentation.
Yeah,
Let me just ask it a different way. Is there any data that shows, for example, because I think the goal is, yes, we like economic activity, but the goal is we represent taxpayers. We want to give them a tax break.
That's right.
That's what I think we should do. And I think that's Representative Carson's goal, is to lessen the burden of tax on individuals through growing out of it, right? So the question is, do we have any data that kind of correlates between 1% less of income tax on a different stratus, income tier, that equals how much economic activity within the state? So we kind of do apples and apples comparison.
Yeah, I haven't done any independent analysis. Let you comment, then I'll. Yeah, let me go back and try kind of. I clearly have not been articulate on this explanation. I am a supporter of reducing the income tax in the state of Georgia without qualifications. There are implications for equity in some cases, but here's the point I was trying to make. At the federal level, when we talk about reducing income tax, we believe that the world is not static. If I reduce the income tax from a 30% rate to a 25% rate, yeah, you'd say, well, that's a 1/6 reduction in the tax rate. Yes, but we believe that you get behavioral responses. That is, people work more, people realize more of their income on their tax returns, they take other entrepreneurial ventures. It's what the guys in D.C. would call, are you doing a dynamic analysis? That is, do you consider how individual behavior responds to changes in the tax rate? My point was, in Georgia, when we talk about bringing down the individual income tax rate, which again I support doing, we need to understand that the way that it feeds back into generating revenue for us will likely be more in terms of improving our competitive position vis-a-vis surrounding states than drastically altering microeconomic incentives that individuals face. Because a 1% reduction in the Georgia income tax, while that's 1/6 of what we would tax people, it's about 1/40th of what their overall income tax burden would be. Where we gain by lowering the income tax is people decide to locate here as opposed to Alabama or South Carolina. And that's true not just for where people want to live, but where entrepreneurs want to locate their businesses.
Just to follow up, is there any data to show, like, if you have an extra $1,000 a year as a taxpayer, is there any data to show that if you have an extra $1,000 a year, you're going to spend $500 of it, and where do you spend it? And so, that's what I'm trying to understand. Like, what is the impact on a family? I think when we talk about sales tax, we're talking about actual dollars out,
right?
At the gas pump, at the grocery store. So I'm trying to understand how do I phrase that, and trying to understand the impact of the individual tax.
Right. I will get some estimates for you, but the way that part of the question was phrased is if you have $1,000 of less income tax, where do you spend it? That's kind of a demand side explanation for tax stimulation, and we certainly can look at what the marginal propensity to consume is and figure out how much of that, and the answer is going to be a lot of it will go into spending. That's old. If you're going to be for being an academic for a moment, that's an old Keynesian way of talking about tax reductions. But if we talk about what you might call supply side responses, that is, how does it impact the decision about work versus leisure, about investing versus saving, about where you locate business, that's a little bit tougher to get our arms around. Economists are constantly trying to estimate the elasticity of tax revenues with regard to the effective tax rate, and sometimes with some precision. And I will share some information with you that shows the elasticity with regard to various components of state and local taxes.
Thank you. Representative Pack, did you want to answer something?
I wanted to bring up one thing. Representative Pack, if you go to the PDF, and there's a link in there to the Tax Foundation Special Report number 207, and I'll make this with one quote in regard to a relationship between the income tax cut and economic growth. So it may not be specifically in regard to how much you spend on groceries or gas or other consumer items, but I'm quoting from page 3 from the Tax Foundation report. They being economic, it was a survey of economists. They find a 1% spending, 1% spending cut has no significant effect on growth, whereas a 1% tax increase reduces GDP by 1.3% after 2 years. Particularly, they find that a tax. Now, I'll find some more detail for you, but there is a corollary relationship between income tax increases and lower growth and income tax cuts and higher growth.
Referred to as the size of the fiscal multipliers and the tax multiplier. Yeah.
Okay, Chairman Reinders.
Thank you, Chairman Powell, and thank you for your presentation. I want to do a little outside the box thinking here for a moment. If we're talking about the income tax and the effect that it has, I would assume that in some areas where the poverty rate may be 49% compared to an area where it's only 20%, then the effect could actually be the reverse if the consumption tax was going on the very people who's in a greater area of poverty. Would you agree with that kind of thinking?
If you cut the income tax, then in poorer parts of the state, it's possible that you would see the savings off the income tax would not be sufficient to offset the increase in sales tax if we use the revenue to do so. But hopefully what it would do is would translate into faster economic growth in the long run. And again, when we speak about the poorer parts of the state, I'm an unapologetic defender of the goods producing side of the economy, because that's really what the less developed parts of the state are very dependent upon.
Thank you so much. If I can continue down that path, Mr. Chairman. Sure. In the underdeveloped parts of the state that we're talking about, we all seem to acknowledge or at least understand the benefits of tax allocation districts within various communities of trying to lift them up. And the theory being you create jobs and you create economic growth and behavioral responses in those particular areas, then the area actually picks itself up because you actually have more rooftops and more people starting to survive or do better economically. Wouldn't that same theory then apply to certain regions instead of just within a certain tax allocation district? Couldn't that same theory also apply that says if we're going to give a break on economic development in this part of the state, you'd actually get more bang for your buck using the exact same dollars in this part of the state and lifting that up just like you would a tax allocation district?
I'd have to think through that. It's a great question. Of course, with TADs, part of the argument is that historically, when we have incentives to encourage, for example, redevelopment of blighted areas, that there are positive externalities for areas that surround it. And so with the TAD, what we're trying to do is essentially monetize the future benefit and use that to finance or incent the redevelopment of the area. So I have to think through what the implications would be with regard to that proposal.
And finally, if I could just boil it down, my point would be if some county has got a 27% income tax or 27% household income versus a 60,000 somewhere else, the effect of reducing that is minimal. Where if we actually reversed and took some of those economic incentives that we're giving to that same area, if you invested $100 million for this company to come here, that $100 million would actually be more in an area here than it would there.
I assume it's possible to
lift more jobs.
To use the revenue in a way to directly incent someone to move into part of the state. Probably the case, but one of the things we tried to do in tax reform is not pick winners and losers among industries, but somewhat try to level the playing field. But I understand your point, and I think that certainly in less developed parts of the state, policies that incent businesses to locate there are game changers.
Thank you, Mr. Chairman.
Chairman Houston.
Thank you, Mr. Chairman. This is directed more to Representative Carson. I really think it's really important. Nothing's more important than jobs. But if we don't do something to change the tax structure in the state, I don't know where our base is going to be, because I know how much the internet has changed my shopping habits, and well, Neiman Marcus has a that's a little person, and I know how much the internet has hurt small businesses in my rural areas. And I appreciate all this focus on jobs, but we cannot. We've got to do something about the way we tax goods and services. And as far as I was thinking, I hate to date myself, but when Representative Knight was talking about how can we tell what we're losing, I can remember. Some of you probably can't remember, on television we used to have antennas, and we sold antennas, and we got sales tax on antennas, and then we had a satellite dish, and you sold the dish, and you got sales tax on the dish, and now you stream everything. So there's no way we can ever tell how much the internet has hurt the tax base. I don't see how you'd ever. I mean, maybe you could estimate it, but it just in that just one little area that I was thinking about. And I appreciate you doing this and all the whole work, because we've got to do something to help these rural areas. Well, everybody too, not just rural areas.
Thank you for saying that.
Thank you, sir. I know. I told you I was dating myself.
Okay. we've got one more witness that we want to hear from. Thank you so much. Kenneth Hegney. There you are. We're going to talk a little bit now because I think that all of us want to be very, very cautious in what we do, that we incent job creation, we make this a competitive state, but we've got to keep in mind that we do not want to do anything that ultimately is going to impact the AAA bond rating that the state of Georgia has. And this witness is going to talk to us a little bit about what the bonding agencies look at when they make those kinds of decisions so that we can evaluate that as well. I have promised him that we will not ask him a question of, if we do this, how is this going to impact us, because that is not a decision that he makes, somebody else makes. And so we can ask about what they view and what they consider important, but as far as asking a direct impact question, I don't think that'll be fair, so I'll ask you not to do that. So if you'll tell us a little bit about yourself and then tell us what you wanted to tell us about bonding agencies.
Thank you, Mr. Chairman. My name is Ken Hagening. I'm the state economist. I'm also affiliated with Georgia State University. And I've been the state economist for a little over 10 years, and before that spent about 20 years as a consultant in private industry. Teresa McCartney couldn't be here today. She asked me to speak to two main points about how rating agencies look at Georgia's credit and how we've come to get a AAA rating, and then talk a bit about the difficulties in implementing major tax reform in a balanced budget environment. So Representative Carson talked about the June rating report that S&P produced. This is also a report they produced which outlines in a fair amount of detail how they rate the 50 U.S. states. And there's a host of criteria in here where they go item by item and assign a specific score for each state against those criteria, and then average those together to come up with an overall rating. And at this point, Georgia has received a AAA rating from S&P, from Fitch, and from Moody's, and obviously we all want to keep that. And in particular, there are two criteria they look at in terms of the revenue structure of the state. And the first criteria is diversity. And specifically, they're looking for a mix of revenue. They're looking for at least two major revenue sources that comprise between 50 to 30% of overall state revenue. And if you meet that criteria, you meet their highest ranking for that specific criteria. And currently we do that between the individual income tax and the sales and use tax. The second factor they look at is flexibility. Can the state change the existing tax structure in a very straightforward manner? And when they talk about tax structure, they're talking about two pieces: the rate itself and then the tax base. And as Representative Carson noted, S&P focused in that ratings report in June on the constitutional amendment that was passed that limited the state individual income or state income taxes to be no more than 6%. They acknowledge that we retained a lot of flexibility to change other taxes, to change the rate base for the individual or the income tax, but the fact that we had limited that flexibility to raise the actual rate itself was taken as a negative for the credit rating. It didn't affect our overall rating at the end, but it's one piece that moves us a little weaker in terms of the overall rating. So those are the two main points we wanted to make in terms of how the rating agencies look at our revenues and our revenue structure. They also look at the estimates. Do they think they're reasonable? They look at how quickly we adjust when revenues fall short of the estimate. We had to do a lot of that during the Great Recession. The other factor we wanted to emphasize was when we're changing taxes, we're dealing in a very uncertain world. We've heard about the difficulties of internet taxation. I think in Representative Carson's bill there's the digital download we don't have direct data on how much revenue taxing that activity would bring to the state. We have general data on how much activity there is at the U.S. level, but then you have to worry about how much of that activity occurs in Georgia, how much of that activity would we really want to tax, because some of that is likely to be business inputs. Software as a service is one of the big internet delivered services currently. A lot of that is business activity. Would we want to subject that to the sales tax? That's a policy decision, but it affects how much revenue we could ultimately drive out of that activity. And we start with a very uncertain size of the total pie even before we start trying to divide that into how much we want to tax versus how much we would not want to tax from a policy perspective. So in terms of taking on a major tax reform, what's clear is we have to deal with the uncertainty. We have to be very cautious in how we score or evaluate the tax revenues that would flow from things that would expand the base or increase a rate, and vice versa, how much revenue we would lose from a policy that would reduce the rate or narrow the base. So ultimately, when we have to balance the budget, we have to be very cautious in terms of how much we can factor into the current revenue estimates about how that's going to affect our revenues in the near term. We've tried to do that as we've come out of the recession. We've built the RSR up considerably. We'll be well over $1 billion after the end of this year. But we've also saw in the Great Recession, you know, dollars can disappear very quickly when revenues are falling. So caution and uncertainty would be, you know, critical to our approach in terms of implementing any major tax reform. So that's my brief comments. I'm happy to take any questions you may have.
Questions? Representative Duncan.
Thank you, Mr. Chairman. And I think this question fits within his confines here, but can you quantify the fiscal effect of what a downgrade looks like in Georgia? Like, how bad is bad from a dollars perspective?
I cannot. I think our the folks at the Finance Commission could give you, based on differentials between AAA and AA plus and other lower ratings, what the implication is for yield spreads and what that would mean to our annual budget.
Thank you.
Any other questions? Okay. You have some information from the Department of Revenue that is useful as far as the current mix of revenue sources. I would encourage all of y'all to forward your email that have all these information dockets to your personal email accounts. I have encouraged Jeremy to collect some of these handouts that have been made, and certainly the one that you referred to, I don't know that we have, and if you could make it available, we're going to scan those in and email them to everybody so that you don't have to have a mix of stuff on your computer and stuff on paper. And as far as the audience is concerned, anybody that wants any of this stuff, just call the Ways and Means office, give your email address, and Laura or Jeremy will forward that to you as well. We have a meeting on a sales tax issue, which I would encourage everybody to be back for, because this is something that certainly we need to hear and perhaps address in the upcoming legislative session. And that meeting will be at 1:30. As far as where we're going to go from here, my personal feeling is, and I would like some feedback from the committee, my personal feeling is that the policy issues are critical to wherever this discussion goes from here, and that I don't know that we are at a point that we want to make a policy decision as to where we want to go, what we want to do. But I would like to hear back from the committee, and I really think that until we have reviewed the information, since we just got it today and obviously we haven't read it, that until we review that information, we won't know what else we want to know and who else we may want to hear from. So what I would suggest is that we digest some of this information we've been furnished, that in another week to 10 days, we circle back. Laura will send you an email and say, what do you think that we ought to do next because there's no point in getting down from the 50,000 foot level to the 25,000 foot level without us making some essential decisions here about revenue mix or however we want to look at it. So I would encourage you to look at that. Laura will send you an email in 10 days or so about, do you want to hear from some more witnesses, whether it be from bonding agencies, economic developers, economists, or whomever it may be. And based on that feedback, we may have another meeting sort of like today. And then at that point, we will make some policy decisions and then move to the next step. And so anyway, that if there's any feedback on that, I would like to hear it now. Otherwise, you'll hear from Laura in about 10 days. All right, we are adjourned. I'll see everybody back at 1:30. And, committee members, we have lunch at the Ways and Means office. Yes.
Leave the iPads, Mr. Chairman? Yes. They're always good. Don't.